Should you pay off debt before you purchase your house? It depends. If your goal is to reduce your debt to income ratio in order to allow you to qualify for a little bit more, it might be a good idea, but you need to make sure that you talk to your lender and make sure that you don't need those funds that you intended to use to pay off debt toward your down payment, closing costs, or possibly reserves. Certain loans will require you to have funds left over at closing in order to get the final approval on the loan. And on top of that, when you're paying off debt and you're trying to have that updated in the system, your lender is then going to be required to track where the funds came from in order to pay off the debt in most cases. Now, what you can do is actually have those debts paid off at close of escrow and just have the money required to pay the debt off be added to your closing costs. That way, your lender gets to mark those as paid at closing, omit them from your debt to income ratio, and the debt will be paid at closing again with your closing costs. However, keep in mind when you are paying off automobiles or any other type of installment loan, like a student loan or personal loan, that closes the account as soon as it is paid off, and therefore you will likely notice a drop in your credit score. And conversely, when you pay off revolving debt like a credit card and you leave the account open, it will boost your credit score because now you have more available credit and it has reduced your debt to income ratio.